Another important basic concept of accounting is the concept of accrual accounting. Accrual accounting essentially records financial transactions based on revenue recognition and matching principles. For example, when a firm sells a product and the customer pays with a credit card, cash is not exchanged, but the firm still can incur the transaction as revenue. On the contrary, cash accounting records transactions only when cash is exchanged. In cash accounting, the sales made using a credit card will not be recorded as revenue until the firm receives the sales amount in cash from the credit card company. In this class, we will focus on accrual accounting. Let's solve an example. Ted's apartment costs $1,000 each month to rent. He decides he doesn't want to worry about forgetting to pay his rent and pays his landlord $12,000 for the upcoming year. Under cash accounting, how much expense would be incurred? Ted paid $12,000 in cash already, so the expense is $12,000. Under accrual accounting, how much expense? Accrual accounting recognizes expense only when the service is provided. In this case, the service is the time Ted actually lived in the apartment. In this question, assuming he lived in the apartment for a month, Ted's expense is $1,000. We will get to the revenue recognition concepts in the next slide. Which is more accurate? I'll leave this up to you to think about. To reiterate the exact definition of accrual accounting attempts to measure firm performance in a particular method regardless of when cash is exchanged. In accrual accounting, there are two main principles: revenue recognition and matching principle for expenses. Accrual is essentially the recognition of revenues and expenses regardless of when cash is received. The intuition behind revenue recognition and matching principle is fairly simple. To recognize revenues, earnings process must be substantially complete, meaning the revenue should be earned and cash collection should be reasonably assured. For matching principle, you recognize expenses in the same period as the associated revenue. Let's discuss the concepts in a bit more detail. Revenue recognition deals with the issue: when do we exactly recognize revenue, and when do we define when a sale is made in accounting? The revenue recognition intuition says that the revenue is recorded when the earnings process is substantially complete. Note that this definition makes no mention of when the cash is collected. Under accrual accounting, we can record revenues and expenses even if no cash changes hands. Matching principle deals with the issue when to recognize expenses in a given period as opposed to revenues. The matching principle states that we should match all expenses to their associated revenues. In other words, whatever cost that's incurred to create a revenue will be recognized once the revenue is realized. Note that this definition requires us to match all expenses associated with revenue, both those that have occurred and those that will occur in the future. This requires estimating future expenses. Why do we do this? We do this to make financial statements more timely and to obtain better measures of profitability. We now discuss each component of financial statements more thoroughly. First, the balance sheet. Within the balance sheet, we find three classifications: assets, liabilities, and equity. Within each of these classifications, we have separate accounts. On the right is a sample of balance sheet of a company XYZ. Each line represents a line item or accounts of the balance sheet. Some items represented here are cash, accounts receivable, inventory, prepaid expenses, and so on. We will learn more about each item as the course progresses. I've mentioned the balance sheet equation briefly a few slides ago. What is the balance sheet equation, or the BSE? BSE is a method of recording individual transactions or events. BSE helps to identify the accounts that are affected, whether the accounts increase or decrease by a certain amount. One important thing to remember is that the equation must always balance at all times. If the equation does not balance, you probably made a mistake somewhere. Let's go over some possible scenarios how BSE can balance out. Remember, assets equals liabilities plus shareholders' equity. First, let's assume one item in the assets have increased. To balance this out, one of three classifications must be affected: assets, liabilities, or equity. If some other item in the assets was affected, that other asset item would have decreased by the corresponding amount. On the other hand, if assets increased and liabilities or equity was affected, then liabilities or equity would have increased. With the same logic, if assets decreased by a certain amount, either some other item in assets would have increased, or liabilities or equity would have decreased by the same amount.